Welcome back to Trendlines Over Headlines, the show where we break down the markets with some of the best traders and analysts out there. My name's Patrick Dunawilla. I'm the editor of the Chart Report, and I'll be your host. We took a little break these past few weeks, but we're back with a great episode for you. Scott Brown is going to be joining us in just a minute to help us make sense of these markets. Scott is the founder of Brown Technical Insights, formerly known as Beat the Bench. The last time we had him on the show was last fall as the market was bottoming, but a lot has happened since then, so I'm looking forward to hearing what he has to say about these markets. But first, it's Friday, the markets are closed, so let's take a quick look at how this week played out. All four major indices closed higher this week by more than 2%. The Russell 2000 and NASDAQ led, with both gaining about 3.6%. The Dow lagged, but it still rose 2.3%, and it actually managed to register its first 52-week high in more than a year on a weekly closing basis. So pretty constructive action at the index level. Taking a closer look at the S&P 500, we're comfortably above those August highs, which are around 4,300, and at this point, 4,600 is the next upside objective for the bulls. 4,600 represents the highs from March 2022, and it's pretty much the last major resistance level to take out before we're talking about a test of the all-time highs. RSI is diverging slightly here, so a pullback wouldn't be too surprising at this point, but there's no reason to get aggressively bearish if we're above those August highs. Taking a quick look at sector performance, all 11 sectors closed higher this week. Consumer discretionary led, gaining about 3.33%. Energy lagged, but it still closed higher, rising about 0.8%. Anyways, that's enough from me. Let's see what Scott has to say. All right, Scott, welcome back to the show. How are you?
I'm good, Patrick. Thanks for having me.
Oh, of course. You having a good summer?
I'm doing great. I literally am leaving for the beach tomorrow morning, so I'm glad we can make this work.
Yeah, that's perfect. Well, I hope you enjoy it. But so the last time you were here was just a couple weeks before the S&P 500 bottomed in October. So we had you at the end of September. S&P 500 bottomed in October. And it's funny, I was watching that episode last night, and you said you were calling for an undercut of the June low. And that's pretty much what we got.
When we look back at how markets bottom, one of the most classic kind of patterns you see is what's called the bang and whimper pattern. And so it's really actually pretty common for that whimper. It's kind of the bang where you see the most intense selling. And it's actually pretty common for the retest to slightly undercut the lows.
Here we are 25% later. We're just like 6% off the all-time highs. So I got to ask you, what levels are you watching on the S&P 500, or maybe indicators too?
Yeah. Thanks for bringing that up. I don't actually remember that. I'm glad we were at least looking at some halfway relevant things. I mean, we got the chart of the S&P 500 up here. I think we've passed the biggest levels. I think, really you want to look more at the internals, the indicators and things like that. But when it comes to levels, it was 4,200, and then it was the August highs. And then once we got up above that, I mean, you're always going to be able to find some sort of resistance levels until you get into blue skies. And there is, some peaks and valleys from the end of 2021 near the 4,550 to 4,600 range. But big picture, I'm not just going to say we're just going to skate there, but I don't think you're selling or you're super worried about stocks rolling over at any of these levels. It always can happen, but as long as we're up above those August highs, I think you got to feel pretty good about the trend in the S&P 500, just kind of in a vacuum looking at the chart here.
Yeah, I mean, you mentioned that we're holding, or we broke and held some really key levels. 4,200 was one of them. We tested it for numerous times for like a year and couldn't do it. But when we finally did, I was expecting 4,300 would be, the next grueling level, but we really just sailed through that one too. So I see what you're saying, kind of as long as we're holding some of those key levels and, former resistance is finally starting to act as support, right?
Yeah, and I mean, we got that textbook kind of a retest of the August highs. I mean, you arguably had a little bit of a bearish momentum divergence, and it just didn't matter. Here we are on Friday, and we're set to head out the week at a new 52-week high again. So, I mean, really, you're always going to be nitpicking if you're finding a problem with 52-week highs.
Yeah, I saw that bearish divergence too, and I thought we'd get a little bit deeper of a pullback. We were still holding above those August highs, so it was tough to get super bearish. But like you said, it's just been resilient, shaking off those bearish divergences. But let me ask you this: do you think all-time highs by the end of the year are in the cards?
I mean, definitely at the pace we're going, I don't get too caught up in those forecasts. I'm not playing options. I don't have a particular need for it to happen by then, but certainly at the pace we're going, and if small caps continue higher, I mean, maybe mega cap growth takes a backseat, but I did a review on Thursday of all the top 7 stocks that really moved the index, and it's hard to find any major problems with them. Some of them are at logical places where you might expect a pause. We're getting into that little bit of a weaker seasonal time of the year come mid-July or so. But if there's any sort of a rally at the end of the year, a pretty small rally is going to get you there by the end of the year, I think.
Yeah, I mean, like I said, just 6% away, right? So one thing you mentioned last time you were on, right before the market bottomed, when you were calling for that undercut of the June lows, is you said, and we were right there when we recorded that last episode. We were at the June lows. We were retesting the bear market lows. And you pointed out that even though we were there again, the new 52-week low list was way higher. There were way more new 52-week lows back in June than there were in September when we were revisiting those levels. So what do you think of breadth here? Yep, you got that chart of the new 52-week lows there. Break it down for us.
Yeah, I mean, so just, skipping ahead to right now, I mean, what we see is pretty good. You can see a couple of weeks ago, we had the best net reading, 52-week highs minus lows since December of 2021. So, I mean, that's just more good signs. We got more stocks breaking out. The new 52-week lows list is basically non-existent. But what we saw last year was really what you see at almost every major bottom. And it's that breadth, kind of the worst breadth, always happens before the index actually bottoms. And so you see here in the middle panel, the most 52-week lows for the S&P 500 occurred in June. Even though the index went on to make a new low in October, there was a less amount of 52-week lows. That's just kind of what almost always happens at major bear markets. And we actually had been, especially on the lookout for it, because for the NASDAQ, for the NYSE, for the Russell 2000, we actually saw 52-week lows peak in May. And so really even in June, it was only the S&P that saw kind of an increase in 52-week lows, but it was already like, hey, should we start to be looking for a bottom here? And it's just the inverse of what, a lot of people have pointed out, that breadth peaked all the way back in early 2021. And so it's just kind of big picture. It almost always plays out this way.
Yeah, and I like that you pointed out too. What did you say? Last week we made a new high, and the net
might be like 2 weeks ago, but we're probably pretty close to heading out the week at a new high there today.
And I'm sure you'd see that as kind of confirmation of a new bullish phase. Is that right?
Yeah, I mean, I think I had somebody ask me, what number is too good or what number are you looking for? And I think to me, it's just the trend. We want to see that bottom number increasing. If you start to see the index still going up and you start seeing less and less 52-week highs, that starts to become a concern. But right now, that number is going up, and it's going up from a low level. So it's kind of all good to me.
Yeah. So on, this look at breadth looks bullish, but there's still a lot of concern over those mega caps leading. We saw a little bit of a pullback, and small caps got a little bit of a bounce, but small caps are still kind of hovering near their lows, whereas something like the NASDAQ, tech heavy NASDAQ with a lot of those mega caps, that's just, climbing not far from all-time highs. So what do you think of that kind of divergence between small caps and mega caps, or some of the larger tech-heavy indices like the NASDAQ.
Yeah, I mean, I think you kind of hit on it right there when you said leading, because leading is okay. Leading is normal. Leading from the mega cap growth stocks is what we've seen for a decade plus. So that, you'd have to be insane to really think that that's bearish. I mean, that's just kind of business as usual. I would say, from that February to May period, it was definitely looked to be a real concern that we've got stocks heading the opposite direction. It was the NASDAQ 100, the largest growth stocks going up, but a whole lot of the market was going down in that period. And what I kind of called out in some of my reports to subscribers in about mid-May was the split stops here. And that's the chart that we're looking at here. And it was IWN, which is the Russell 2000 value, obviously a ton of regional banks. We all know about the problems from the first half of the year. And they were kind of back down on support. And at that same time, QQQ was up into its August highs. And the case I simply made was, I don't know which way this is going to resolve, but I think this is where the split, the opposite direction of these two stocks has to stop. Either IWN is going to break down to new cycle lows and QQQ stalls out at the August highs, or they're both going to work higher. And for now, IWN's up above. So our working assumption is that, we're still okay. And luckily in the past 2 months, that's what we've seen is we've seen IWN move out. It's breaking out to 1 month highs. And we've seen QQQ not only take out those August highs, but also take out some resistance this week up near 375 or so. So, I mean, as long as IWN is up above 130 or so, there's some bullish divergences for relative leadership that haven't quite translated to price for small caps. But from the overall health of the market perspective, as long as we hold those lows, it's another kind of, we're good here.
Yeah. So do you think that kind of rotation into small caps that we've seen just maybe this week, you think that'll continue?
In some of our models do have a small tilt out of benchmark bet towards small caps, kind of based on that big bullish divergence. And if it breaks down to new relative lows versus the S&P 500, it's kind of a counter trend trade. If it breaks down, then we'll just kind of move on and be out. I do think that if there was ever a time for it, it's right now.
Yeah. Well, listen, one of the big developments this week and something that got a lot of chatter was this comeback in ARK ETFs, right? And it wasn't just ARKK, it was some of the others, right? Like ARKF and ARKW also kind of threatening to new 52-week highs. So you brought along some ARK charts for us. Tell us what you're seeing here.
I mean, you see ARK here, I mean, in kind of the flagship fund, with a lot of textbook technical formations in here. I mean, it found support kind of right where it found support over the past 5 years, a very, very textbook inverse head and shoulders pattern. And even though, this thing has nearly doubled from its lows, it's arguably just testing the neckline now. We know that when this thing gets up and goes, it can really go, but it does look to be a very classic bottoming formation. So I think you'd have to be, insane to be bearish on this chart right now.
Is ARKK like kind of your favorite here, or do you prefer some of the others? Have you taken a look at those?
I think if you look at ARKF, this one is already hitting 52-week highs versus the S&P 500. It's arguably a little bit cleaner of a chart, and it's already broken out above the neckline. So if I'm just kind of looking at this from a technical perspective, this is kind of the prettiest one to me. But whether you look at ARK, in my old shop, I just used to look at these things as a proxy. Now you can look at all the individual things in the space. Coin this week, almost every one of these former high flyers that dropped 80% has some form of an inverse head and shoulders pattern. And it's basically they've either broken out or it looks like they're going to break out. And so I'm definitely willing to kind of ride that trend. Maybe once everything's broken out, we're due for a pause. But right now, it kind of seems like we're in the middle where there's still a lot of things that have yet to break out. And so I'm inclined to think this has more room to run.
Yeah, these ARK ETFs were really the poster child of some of that speculative froth that you were seeing towards the peak in February 21 and stuff like that. So they really haven't participated this year up until maybe this week, right? What does that tell you about the broader market and participation outside of just trading these things? What does it tell you in terms of the broader market? Maybe, further outperformance from growth, or how are you interpreting that?
Well, what's interesting is it's kind of come as we've also seen a rotation into things like industrials. I mean, you got the equally weighted industrials ETF breaking out. So it's almost kind of everything else catching up to those top growth stocks, because these really didn't participate, as you mentioned, in the initial rally earlier this year when it was the, let's call them the safer growth stocks. But it's I think a sign of risk appetite for sure. I mean, we've seen high beta outperform low beta. I mean, nothing's been worse than low vol stocks. We've seen equally weighted discretionary outperforming equally weighted staples. And I mean, if you're playing this, I mean, what can be more risk on than some of these very, very high beta growth stocks breaking out? I mean, it definitely seems like a liquid bull market type of environment.
Yeah, it's been cool to kind of see the progression of it too. First, it was ARKK, then the fintech one you have up here, and you have the ARK W one too, right?
I mean, it's the same thing, a little bit slopier of a neckline here, but still getting real close to 52-week relative highs versus the S&P 500. It kind of looks like Coinbase with that slanted neckline, but it's breaking out there.
Yeah, and a lot of the decline in these ETFs or just growth in general got blamed on two things, really, the dollar and rates. But let's start with that second one, rates. It's been a confusing outlook really all year. You know, we peaked last year and have just been kind of basing. You know, last week it looked like we were about to break out and retest that 4.25 level. But then this week we've seen almost every day this week, except for today, Friday, rates have been down. So what's your outlook for rates here? Do you have any conviction on that?
I have no conviction on where rates are going inside of these ranges here. You know, it's about a 60 to 70 basis point range for the 10-year yield, a little bit smaller one for the 30-year yield, which I think has the kind of cleanest chart. I mean, the 30-year yield is kind of still an uptrend. You know, it's still up above I know I don't have a plotted, but still up above a rising 200-day moving average. But these all were rejected hard at clearly defined resistance points. I do think that that's a good thing. I was kind of, a little bit wary, like, we break out here, can growth stocks keep doing well? Maybe that's still an open question for some other point in the year, but it looks like we've kind of sidestepped it for now. I don't think you can be a huge bond bull, and so we really see decisive breakdowns below the bottom of all these ranges. Call it 3.5 on the 30-year, definitely below 3.20 on the 10-year yield. But it's hard to be too worried as long as resistance continues to hold on the top end.
Yeah, so just kind of in no man's land and tough to have conviction till we get out of this range, right?
Yeah, and I think that might be just the best backdrop for stocks, because 325 is some major multi-year support for the 10-year yield. I do kind of suspect that maybe we don't break down until there actually is a recession, a bear market, the true flight to safety. And so maybe that wouldn't necessarily be a good thing. And so maybe the best environment is just kind of sideways and shop and no real rate volatility either direction.
Yeah, well, listen, I appreciate you telling us how it is rather than, it's just range bounded. There's nothing to really have conviction about till we do break out of those. And it did really look like we were going to break out last Friday, but then, like I said, just rolled over, right? So let's move on to the other wrecking ball, the dollar, right? Really constructive development there. You got new, 2-year lows almost? Definitely a new 52-week low in the dollar index this week. Break it down for us. You said it's the worst week, is that correct?
Worst week since November, down about 2.4% through Thursday's close. I think it's pretty unchanged here today. But yeah, I mean, taking out that 101 level, and it's just, there was arguably a little bit of a peak or some support back at 104, maybe should have been a stronger warning sign that 101 wasn't going to hold. And, I mean, just big picture, where do you see the support? I don't see a lot. I'm not saying we have to go to 88, but it definitely,
I was going to say 89. That was my level.
It's kind of a simple thesis. If we're below 101, my bet is dollar lower. And I think that's probably good for everything. That's good for U.S. stocks. I know JC Peretz has been sharing a great chart of just how well correlated the RSP equally weighted S&P 500 is to the dollar. But I mean, even just the classic rest of the world. I mean, that's what you used to, I think of. It's been so horrible for so long, but this is where that weaker dollar is a direct benefit to your investments. It's not just earnings and kind of hypothetical good. It's just like, well, you're long euros or yen, and they're getting stronger. And so this is the AQUI X, or the All Country World US, just breaking out above a really clean kind of point here. This, call it $50 a share. That was the pre-COVID highs. It's been resistance for the past 4 or 5 months, and we shot up above it on Thursday.
That's a great point and a great chart too. I never really thought dollar, I didn't think to make that extra step, dollar weakness, even better for international markets, right? Yeah, definitely. I mean, it's directly helping. It's a direct tailwind, just like dollar strength is a big headwind to international equities. So, it's been a rough trend. I mean, the relative chart is nothing to, write home about, but you can see a little bit of uptick here, at least, with some outperformance for the rest of the world versus the S&P 500 over the past week or so. Oh yeah, that relative chart on the bottom there. I really think, maybe you would agree, maybe you disagree, but I really think that dollar breakdown that we saw this week, that was an extremely positive thing for stocks. Everybody's been kind of waiting for that, or at least the bulls have been waiting for that as kind of a catalyst, right? And you haven't really seen it until this week. My level was kind of 103. You said 101, and we kind of go back and forth between some of the analysts we have here. So one of my friends, his level was 105. Mine was 103. Yours was 101. But regardless, we're below all of them.
We're below all of them. Yeah.
We finally cracked 100.
Lows. There's no question about what's going on.
Right. The word decisive comes to mind, right? Decisive breakdown, which is what you're finally starting to see in the dollar. Scott, well, I think we got to leave it here for today. We got to wrap it up, but thank you for joining us. And real quick before you go, I noticed you rebranded away from Beat the Bench. So tell us a little bit about this rebrand and give us a quick update if you would.
Yeah. People that are used to following me might know me from Beat the Bench. That's the company that I started about 10 months ago. And I was actually going to announce this next weekend, but since you gave me the great platform here, wanted to go on and roll it out. But just going forward, Beat the Bench will be known as Brown Technical Insights. I got a new logo on there, and also we've got a promotional link in the comments section. So for anybody, or down in the description, for a free 1-month trial to Brown Technical Insights. So if you want to sign up, go in and do that and get a free 1 month to all the reports, all the archives and past reports. But yeah, going forward, Beat the Bench will be Brown Technical Insights. I got a new logo that my friend Katrin Painter of Sweet Horizon Studios did. And I think it looks pretty good, and I'm excited for a fresh start.
Awesome. Well, thank you so much for that freebie too. And like you said, if our viewers are interested in signing up, it's right in the link to the description of this video. But I always enjoy reading your notes, so I'm glad nothing's changing as far as the notes and the research goes, because you always share some really great work, some great charts. So thank you for that, and thank you so much for coming on. I hope you have a great time at the beach this weekend.
Thanks for having me.
Of course. Thank you guys for watching. If you enjoyed the show, be sure to click like and subscribe. We'll see you again next week. Thanks.